Hey everyone, and welcome to This Explainer. Today, we're taking a really fascinating top-down approach to make sense of the deeply conflicting forces that are, honestly, just ripping through the global forex markets right now. If you've been watching the charts lately, well, you already know it's a wildly volatile environment out there. So we're going to navigate what we call the macro to micro funnel. We'll start way up high with global policy decisions, and then let that trickle all the way down to hard currency projections. Okay, let's dive into this. Here's our roadmap for the day. First, the central bank tug-of-war. Second, inflation and energy shocks. Third, EURUSD technical analysis. Fourth, the GBP, JPY, and CNY outlook. And finally, number 5, long-term currency projections. Let's get right to it.
Section 1. The central bank tug-of-war.
So the absolute overarching narrative in the Forex world right now is this massive divergence in central bank policies. We're seeing major global economies moving in completely opposite directions, and that's exactly what's creating these aggressive market swings. Now, to understand the US side of this equation, we really need to define a vital term, the hawkish hold. You know, it's basically a decision by a central bank to keep interest rates exactly where they are, while heavily signaling to the market that future rate hikes are way more likely than cuts. And this is crucial right now because the U.S. Federal Reserve, under its new chair Kevin Warsh, recently executed this exact textbook move.
The immediate disparity in the market is super clear when you look at it like this. On one side, we've got the U.S. Fed executing that hawkish hold, freezing their target range at 3.50 to 3.75%. But then, on the flip side, we have the European Central Bank, led by Christine Lagarde, actually initiating its first rate hike since 2023. They just bumped rates up by 25 basis points to 2.25%, so the US is pausing while Europe is actively tightening.
And get this, the crucial point here is this staggering number, 12-0. That was the unanimous vote by the Federal Open Market Committee to hold rates. I mean, despite broad market expectations earlier in the year that the Fed would be cutting rates by now, there was absolute, total alignment among U.S. policymakers to hold firm, not a single dissenting voice. They are 100% united in this wait-and-see approach.
Section 2, inflation and energy shocks. So, why is the Fed so fiercely united in holding rates high while Europe feels the sudden need to hike? Well, it all comes down to global inflation. U.S. headline inflation is running incredibly hot at 4.2%. To put that into perspective, that's double the EU's remarkably stable inflation rate of 2.1%. But notice the split here. U.S. core CPI, which, strips out volatile things like food and energy, is sitting much lower at 2.9%. This glaring gap between headline and core data is exactly why the Fed held. That 4.2% headline number is just way too dangerous to ignore.
And why is that headline number so intensely high? It honestly boils down to this single, staggering figure, 23.5%. That's the year-over-year spike in energy prices, driven directly by geopolitical conflict in the Middle East. This massive energy shock is the main culprit keeping U.S. inflation elevated, and consequently, it's basically the anchor holding the U.S. dollar in its dominant, strong position right now, as the Fed aggressively guards against those prices becoming entrenched.
Section 3. EURUSD technical analysis.
Okay, we've established the macro fundamentals. Now, let's zoom in a bit and look at the micro-level chart realities. Looking at the weekly candlestick charts, the EURUSD has slumped from its January high and formed a classic head and shoulders pattern. As you can see, this is a very common bearish reversal indicator. It literally looks like a head flanked by two shoulders. And right now, the euro is hovering dangerously near this pattern's neckline. If candlesticks close below this line, man, that's a strong technical signal that sellers are fully in control. Adding to that bearish sentiment is the RSI, or Relative Strength Index. It's currently hovering right near 36. In technical analysis, an RSI at this level shows that negative momentum is absolutely still driving the bus. The pair is approaching the oversold zone, but it hasn't fully entered it yet, which effectively leaves the door wide open for even further euro decline before we might see any strong reversal signals. Now, for those of you looking for practical checkpoints, here are some actionable scenarios derived directly from daily Forex analysis. Think of these as your practical if-then parameters. For a buy scenario, support is pegged at 1.1345, targeting a bounce to 1.1430, with a strict stop at 1.1300. Conversely, if you're looking at a sell scenario off of a bounce, resistance sits at 1.1530, targeting a drop back down to 1.1400 with a stop at 1.1600. These are absolutely the technical battlegrounds you're going to want to watch. Section 4. GBP, JPY, and CNY Outlook.
Let's shift our focus away from the euro for just a second and examine how the British pound, the Japanese yen, and the Chinese yuan are reacting to this really intense macro environment of high US rates and energy shocks. The dynamics here are fascinating. The UK economy moves largely in parallel with the Eurozone, mainly because they're also a net importer of energy. The Bank of England recently held rates at 3.75% after a surprisingly sharp drop in services inflation. Meanwhile, over in the Asian markets, the US dollar's sheer yield advantage just continues to dominate in the short term. The yen has been tracking around a historically weak 162.53, and the Chinese yuan sits at 6.78 against the very strong dollar.
But what happens when we look a little further out? We've got these massive institutional forecasts from Deutsche Bank and MUFG for mid-2027, and they show a really clear trend. Deutsche Bank actually sees the pound surging to 144 and the yen recovering significantly to 145. MUFG is slightly more conservative, putting the pound at 134.8 and the yen at 154. Actually, when we look at the yuan, both agree on 660. The general consensus across these major institutions is super clear. As U.S. inflation eventually cools off and the Fed is forced to cut, the U.S. dollar is expected to weaken against these major global currencies by next year.
Section 5. Long-term currency projections.
So let's step all the way back now. We've looked at the short-term technical doom and gloom and the mid-term institutional forecasts. Let's look at the ultimate long-term trajectory for the Euro-USD. Compiled from Attijari and Bloomberg consensus data, a really surprising picture emerges. Despite the current bearish technicals, the long-term fundamental consensus is actually a steadily rebounding euro. By the end of 2026, analysts project the pair returning to the 1.18 to 1.20 range, moving into 2027, climbing up to 1.20 to 1.22, and looking way out to 2028 and 2029, settling between 1.22 and 1.23. The fundamental belief here is that the narrowing interest rate divergence between the US and the Eurozone will eventually pull the euro back up. To ground all of this super dense data and practical reality, let's look at this quote from Anthony Bull at Cambridge Currencies. He notes, and I quote, "The Fed didn't move, but it told markets the next move is more likely to be up than down. A forward contract lets you fix today's rate ahead of the 29 July meeting rather than betting on the outcome. This hits the nail right on the head. It shows exactly why these fluctuations matter right now. If you're a business managing global capital or you're paying overseas suppliers, the threat of a hawkish Fed means you have to actively manage your risk today, not tomorrow." And that brings us to the absolute most important dates you need to circle on your calendar. These are the macro landmines directly ahead of us. On July 22nd and 23rd, the ECB meets again. Are they going to hike for a second time to fight off imported energy inflation? And then, just days later, on July 29th, we get the next Federal Reserve FOMC decision. This back-to-back sequence will absolutely determine if the central bank tug-of-war escalates or if it finally resolves. So, I'll leave you with this provocative question to ponder. With the U.S. fiercely fighting stubborn energy inflation with a hawkish hold, and Europe acting early with rate hikes to stop it, which central bank will ultimately dictate the global financial trend for the rest of 2026? It's a high-stakes standoff, for sure, and the charts will reflect every single word these policymakers say. Thank you so much for your focus during this explainer, and remember, keep watching those charts.